In this video, we are going to discuss few MCQ questions on statement of changes in equity and equity transactions for CMA US Part 1. First question, which of the following statements regarding dividend is correct? Let's look at the first option. A stock dividend of 15% of the outstanding common shares results in a debit to retained earnings at par value of the stock distributed. See, whenever there is a question on stock dividend, first we have to identify whether it is a small stock dividend or whether it is a whether it is a large stock dividend. How to identify this? If the percentage given in the question, if it is somewhere between 20 to 25%, then we call it as a small stock dividend. If it is greater than 25%, like 30%, we call it as a large stock dividend. Now, the journal entry for small stock dividend and large stock dividend, it's almost the same, which we will discuss in the subsequent questions. In both the cases, what we have to debit is we have to debit retained earnings. In case of small stock dividend also, we will debit the retained earnings. In case of large stock dividend also, we will debit the retained earnings. But the important point that we need to keep in our mind is, in case of small stock dividend, the retained earnings will be debited with the market value amount. But in case of large stock dividend, the retained earnings will be debited with the face value or par value amount. So here 15% stock dividend is given. 15% is a small stock dividend. So in that case, while passing the journal entry, a debit to retained earnings should be at the market value or fair value. It should not be at the par value. So this option cannot be the right answer. Instead of par value, let's say if they have given fair value or fair market value, then this answer would be right. But since they have given, in case of small stock dividend, if the retained earnings is to be debited by par value, it is not the right answer. So option A cannot be the right answer. Let's look at option B. At the declaration date of a 30% stock dividend, so it is a large stock dividend, the carrying value of the retained earnings will be reduced by fair market value of the stock distributed. Again, it is a large stock dividend. So for where the retained earnings should be debited with the par value. It should not be debited with the fair market value. So again, instead of using the term fair market value here, if they had used the term par value, then this option would have been the right answer. Because large stock dividend, retained earnings should be debited with the par value. But here they have taken fair market value. So option B cannot be the right answer. The declaration of a cash dividend will have no effect on the book value per share. Obviously, this cannot be the right answer because if you're at the time of declaration of cash dividend, what is the journal entry we will pass? We will debit retained earnings and we will credit dividend payable, which is a liability. So here what is happening? Equity is reducing, right? Why equity is reducing? Because we are debiting the retained earnings. If equity reduces, then obviously book value per share will decrease, right? So option C cannot be the right answer. Now let's look at option D. The declaration and payment of 10% stock dividend. First, identify whether it is a small stock dividend or a large stock dividend. Here it is 10%, which is less than 25%. So it is a small stock dividend. The declaration payment of a 10% stock dividend will result in reduction of retained earnings at the fair market value of the stock. So option D is the right answer. In case of a small stock dividend, the retained earnings should be debited with the market value and not with the fair value. So option D is the right answer. We will see numericals based on this concept in the subsequent questions. But here, what is important to understand is, if it is a small stock dividend, retained earnings should be debited with market value. If it is a large stock dividend, retained earnings should be debited with the par value amount. Let's look at the second question. A public company has declared a property dividend of 1 share of its investment in M Corporation for every 10 shares of its common stock outstanding. So what they have done is, they might not have sufficient amount of cash to pay as dividend. So what they are doing is, this public company has invested in a company called M Limited or M Corporation. So for every one share held by the shareholders of this public company, they are giving 10 shares of, sorry, for every 10 shares held by the shareholders of this public company, the company is giving one share of M Limited as dividend. So to put it very simple, instead of paying out cash as dividend, this public company is paying out stock as dividend. So it is called a property dividend. The M shares were originally purchased by the company for $50 per share. So when this public company acquired the shares of M Limited, it was purchased for rupees 50 or $50. On the date the dividend was declared, the market value was $75 per share. As a result of this declaration, the company should recognize what? So see here, this is a question based on property dividend. So in case of property dividend, what we have to do is on the date of declaration, whenever the dividend is declared, on the date of declaration, the property should be revalued to its fair value. Here, which property is being paid out as dividend to the shareholders? The shares of M Limited is being paid out as dividend to the shareholders of this public company. So shares of M Limited is the property here. At what price it was purchased? It was purchased for $50. But currently, that is on the date of declaration, what is the fair value of this property or of this share? It is $75. So it increased by $25. So this public company should record a gain of 25 rupees per share to be distributed. So option B is the right answer. So here in this question, what is the concept that we need to understand is if it is a property dividend, on the date of declaration, the property should be valued to its fair value. Third question, a company has 1 million shares of common stock authorized, of which 1 lakh shares are held as treasury shares. So total authorized shares of the company is 1 million shares, and the company is holding 1 lakh shares as treasury shares. Treasury shares are nothing but the shares which is owned by the company itself. The remainder are held by the shareholders. So out of 10 lakh shares, 1 lakh shares is the treasury stock and remaining 9 lakh shares is the common stock. Common stock is the shares that is in the hands of the shareholders. On 1st November, the board of directors declared a cash dividend of $0.1 per share to be paid on 2nd January. So here what is important to understand is we have to identify the declaration date. So on which date the dividend is declared? The dividend is declared on 1st November. And when the dividend is going to be paid, it is going to be paid on 2nd January. So on which date we have to pass the entry? The entry should be passed on the date of declaration. So on which date the dividends are declared? 1st November, right? So on 1st November, we have to pass the journal entry for this cash dividend. So on November 1, what will be the entry in the books of the company? The company will debit retained earnings. They will credit dividends or dividend payable. What is the amount they have to pay? See, please remember on treasury stock, treasury stock will not receive any dividend because treasury stock is with the company. The company cannot pay dividend to itself, right? So dividend should be paid only to the common stock. So what are the common stock? 9 lakh shares are outstanding or 9 lakh shares are held by the shareholders. For each share, we are going to pay 0.1 rupee dividend. So $0.1 dividend. So 9 into 0.1, we get 90,000. So debit retained earnings by 90,000 and credit dividend payable by 90,000. This is the journal entry on 1st November. Now, when the dividend is actually paid, the dividend is actually going to be paid on 2nd January. So on January 2nd, what is the journal entry we have to pass? On January 2nd, see, we have already credited dividend payable. Basically, it is a liability, right? Now, this liability is going to decrease on January 2nd. Why? Because dividend is paid. So decrease in liability should be debited. So debit dividend payable 90,000 rupees. And what we have to credit? We have to credit cash because cash is actually going out on 2nd January only. So 90,000 cash we have to credit. Now reading the question further. At the same time, the board declared 5% stock dividend to be issued on 31st December. So here, 5% stock dividend means it is a small stock dividend. On the date of declaration, the stock was selling for $10 per share and no fractional shares were to be issued. The total amount of these declarations to be shown as current liability on the statement of financial position as of 31st December is how much? So they are asking how much rupees should be shown as current liability for the year ending 31st December, whatever, 2024 or 25, whatever the year is. So in this question, basically there are two dividends. One is a cash dividend, which is declared on 1st November, paid on 2nd January. And the other one is a stock dividend, which is declared on at the same time the board declared. So the stock dividend is declared on 31st December, right? Now we saw what is the journal entry for cash dividend. Similarly, let's see how what is the journal entry that needs to be passed for stock dividend. So first, what we need to identify in case of stock dividend, whether it is a small stock dividend or a large stock dividend. Here, it is a 5% stock dividend. So obviously it is a small stock dividend. If it is a small stock dividend, the retained earnings should be debited with what amount? It should be debited with the market value and not the face value. Here, face value is not given, but to explain the concept, let's assume par value is equal to dollar 5 per share. Now, what is the journal entry that we have to pass for the small stock dividend? The journal entry is we have to debit retained earnings, right? How many shares we are going to give as stock dividend? 5% of the total number of shares outstanding. How many shares are outstanding? 9 lakh shares are outstanding. So 9 lakh into 5% we get 45,000. So we are going to pay 45,000 shares as 45,000 shares as stock dividend into what is the market value of the share? It is 10. So 45,000 into 10 we get 4 lakh 50,000. We have to debit retained earnings for 4 lakh 50,000. Now, what is that we have to credit? Here, stock is paid out as dividend. There is no cash coming into picture. Cash is not coming into picture here, right? And there is no liability as well. You have to, instead of paying cash as dividend, you're just paying stock as dividend. So basically, your share capital of the company is increasing. So what we have to credit? We have to credit equity share capital of the company, right? Here we assumed par value is equal to rupees 5 per share. So we are going to pay 45,000 shares as dividend into 5. So equity share capital should be credited by 2,25,000. Then where the remaining amount of 2,25,000 will go? The remaining 2,25,000 will go to additional paid in capital. So 2,25,000. So what is important to understand is in case of a cash dividend on the date of declaration, it is retained earnings to dividends payable, and on the date of payment, the journal entry will be dividend payable to cash. So here a current liability is created and then the current liability is reduced when the cash dividend is paid. But in case of a stock dividend, we debit retained earnings with, in case of a small stock dividend, we debit retained earnings with the market value. Then we credit equity share capital. Why? Because we are paying out shares as dividend. So as a result, equity share capital is increasing. And the remaining amount will go to additional paid in capital. So this is the journal entry for a stock dividend. And most important thing that we need to observe here is a stock dividend will not impact the total equity of the company, which means retained earnings is also a part of equity. Equity share capital is also a part of equity, and additional paid in capital is also a part of equity. So from retained earnings, we are just transferring the amount to equity share capital and additional paid in capital. So the impact on total equity is nothing, right? So stock dividend will not impact total equity of the company. Now, coming back to the question, what is the requirement? The total amount of these declaration to be shown as current liability on the statement of financial position as of 31st December is how much? So in case of stock dividend, there is no current liability, right? It is going to impact only the equity side of the balance sheet. That is, from retained earnings, amounts are transferred to equity share capital and additional paid-in capital. Impact on total equity is nil. There is no current liability here. But when you look at cash dividend, there is a current liability of 90,000, right? So current liability will come into picture only at the time of cash dividend. So what is the amount? 90,000. So option A is the right answer. Question number 4. A corporation has 10 million shares of rupees $10 par value stock authorized, of which 2 million shares are issued and outstanding. So the authorized, the company has authorized to issue 10 million shares, but so far they have issued only 2 million shares to the shareholders. Only these 2 million shares are outstanding. The board of directors declared a 2-for-1 stock split on November 30 to be issued on December 30. The stock was selling for $30 per share on the date of declaration. In addition, so this 30 is the market value. In addition, the board has amended the articles of incorporation to allow for a proportional increase in the number of authorized shares. The par value information appearing in the shareholders equity section of the statement of financial position at 31st December will be how much? So basically in this question, the company is declaring a stock split on 30th November. As a result, what will be the par value that will be shown in the balance sheet? That is what they're asking us to calculate. To put it simple, as a result of the stock split, what is going to be the impact on the face value or par value of the equity shares? That is what we have to calculate. So in case of a stock split, first point that we need to understand for a stock split is there is no journal entry for stock split. We are not going to pass any journal entry for stock split. Then how the stock split works? Listen, the board of directors declared a 2-for-1 stock split. What does it mean? It means that for every 1 shares held or for every 1 share held, the company is going to give 2 shares to the shareholders. If you are holding 1 share, the company will give you 2 shares. Now, what is the total number of shares outstanding? 2 million shares are outstanding. So for 1 share, if the company is going to give 2 shares, then for 2 million shares, how many shares totally the company is going to give? Totally, they are going to give 4 million shares. So 4 million share, before stock split, it was 2 million. After stock split, 4 million shares are going to be the number of outstanding shares. So we discussed 2 points for stock split so far. First point, there is no journal entry for stock split. Second point that we discussed is how to understand this. 2-for-1 stock split means for every 1 share held, company is going to pay 2 shares. Then for 2 million shares, the company is going to give 4 million shares to the equity shareholders. Now the third point that we need to understand is, as a result of stock split, there is going to be no change in the total value of the equity share capital, which means before stock split, the company had 2 million shares outstanding. What is the face value of 1 share? It is 10. So 2 million into 10, we get 20 million. Right? Even after stock split, this 20 million should remain the same. Stock split is not going to impact the total share capital of the company. So even after stock split, the company should have share capital of 20 million. So in that case, what should be the par value of the stock? So just take this 4 million to the other side. We will get par value or X is equal to 20 million by 4 million. We get $5 per share. So option A is the right answer. So after stock split, the value of the share will decrease from 10 per share to 5 per share. Or the easiest way to calculate is before stock split, face value is 10. The company is giving 2-for-1 stock split. So value of 1 share is, if you are holding 1 share, it is going to become 2 shares. So 10 by 2, we get 5. So option A is the right answer. Let's look at question number 5. How would a stock split affect the par value of the stock and company's shareholders' equity? Just now we discussed, because of a stock split, the number of shares are going to increase, right? If number of shares are increasing, then par value should decrease to maintain the same equity share capital. So a stock split will decrease the par value of the company. So option C and D cannot be right. Either A or B has to be the right answer. Because of stock split, par value of the company will decrease. Here you can see, before stock split, it was 10 per share. Par value was 10 per share. After stock split, par value has become rupees 5 per share. So par value will decrease. What about shareholders' equity? There is going to be no change in the shareholders' equity value. So as a stock split, as a result of stock split, par value of the share will decrease and no change in the shareholders' equity. You can see that from this question also. Before stock split also equity shareholders equity is 20 lakh. After stock split also shareholders equity is 20 lakh. So as a result of stock split, number of shares will increase. Shareholders equity will remain the same and par value will decrease. So here option B is the right answer. Sixth question. On 15th December, a company distributed a previously declared cash dividend of 1,20,000 and declared 5% stock dividend with a market value of 1 lakh. If the company uses US GAAP, these two transactions would decrease the company's total shareholder equity by how many rupees? So here we have to understand two things. One, the company distributed a cash dividend. The company is not declaring the cash dividend. The company has distributed a cash dividend of 1,20,000. So what is the journal entry we are going to pass? The journal entry will be debit dividend payable, because it is a distribution of dividend. We are not declaring dividend. On 15th December, the dividend is paid. So debit dividend payable and credit cash 1,20,000, 1,20,000. So this journal entry is going to have no impact on the shareholders' equity. Why? Because liability is reduced and asset is reduced, right? There is no impact on the shareholders' equity. So as a result of cash dividend, there is no impact on shareholders' equity. Now, then the company declared 5% stock dividend with a market value of 1 lakh rupees. So what is the journal entry we will pass for a stock dividend? Here it is a small stock dividend because only 5%. We have to debit retained earnings. Market value is 1 lakh. So debit retained earnings 1 lakh. And what we have to credit? We have to credit equity share capital 1 lakh. Right? So here, this journal has no impact on shareholders' equity. When you look at this journal entry, 1 lakh rupees getting transferred from retained earnings to equity share capital, from one equity account to other equity account. So what is the impact on shareholders' equity because of this journey? Again, no impact. Right? Because see, retained earnings is reducing, but equity share capital is increasing. So the total equity remains the same. So there is no impact because of these two transactions. So option A is the right answer. 0 is the right answer. Question number 7. Morton Company declared and issued 10% stock dividend. So again, it is a small stock dividend during the current year. The effect of this stock dividend on the following was. So because of a stock dividend, what will be the impact on par value per share? Par value is nothing but face value. What is going to be the impact on face value because of stock dividend? There is going to be no impact, right? It is not going, a small stock dividend is not going to impact the face value. So either option C or D has to be the right answer because no effect on par value. When you look at retained earnings, because of declaring a 10% stock dividend, that is because of declaring a small stock dividend, what is going to be the impact on retained earnings? Retained earnings will reduce. That is the reason why in case of stock dividend, we are debiting retained earnings, right? A debit to retained earnings means that retained earnings is decreasing. So either again, option C or D has to be the right answer. What is going to be the impact on total equity because of a small stock dividend? In this question also we discussed what is going to be the impact on total equity because of small stock dividend? No impact. Why? Because for a small stock dividend, we will debit retained earnings and we are going to credit equity share capital. So no effect on total equity, right? So option D is the right answer. No impact on par value per share. Retained earnings will reduce and no impact on total equity. Option D is the right answer. Eighth question. A corporation's common stock has a market price that is greater than its par value. The corporation is considering a small stock dividend, a large stock dividend, or a stock split. Which of the following would change additional paid in capital on the balance sheet? The question clearly says the market price is greater than the par value. So let's assume that the market price is 10 and par value is 5. Let's say the company is going to give a small stock dividend of, let's say, 500 shares. Now, what is the journal entry we will pass? We have to debit retained earnings. So we are talking about small stock dividend. In case of small stock dividend, retained earnings should be debited with the market value. So 500 into what is the market price? 10. So 500 into 10, we get 5,000. What we have to credit? We have to credit equity share capital. How many shares? 500 shares we are issuing as stock dividend. But what is the par value? Par value is only 5. So 500 into 5, we get 2,500 credited to equity share capital. Then where the remaining 2,500 will go? The remaining 2,500 will go to additional paid in capital, 2,500. So a small stock dividend would bring a change in the additional paid in capital. Now let's see what will happen in case of a large stock dividend. For example, let's say the company is issuing, for example, let's say the company is issuing 5,000 shares as a large stock dividend. So in that case also we have to debit retained earnings, but retained earnings should be debited with the par value of the stock. What is the par value? 5,000 into par value is 5. So 5,000 into 5, we get 25,000. And what we have to credit? We have to credit equity share capital. So equity share capital should be credited with par value, 5,000 into 5, 25,000. So large stock dividend will not impact the additional paid in capital. So small stock dividend will impact additional paid in capital, whereas a large stock dividend will not impact additional paid in capital. Why? Because large stock dividend, in case of large stock dividend, the retained earnings is debited with the par value only. Equity share capital is also credited with par value only. So there is no impact on additional paid in capital. And the third transaction is stock split. But we know that in case of a stock split, we are not going to pass any journal entry. Stock split will just increase the number of outstanding shares. It will decrease the face value of the share. There is going to be no impact on the total equity as well. So stock split, obviously, it will not impact additional paid in capital. So any option with stock split can be easily eliminated. So option A is the right answer. Only small stock dividend will impact additional paid in capital. Large stock dividend and stock split will have no effect on additional paid in capital. Ninth question. A company has 1,000 shares of rupees of $10 par value common stock and 5,000 of retained earnings. Two proposals are under condition. The first is a stock split, giving each shareholder 2 new shares for each share formerly held. What they are saying is, for every 1 share held by the shareholders, the company is going to pay, or the company is going to give 2 shares. So this is one proposal. So because of this proposal, what will be the total number of shares? For 1 share, if the company is going to give 2 shares, totally there are 1,000 shares outstanding. So for 1,000 shares, 2,000 shares should be given additionally. The second proposal is to declare and distribute 50% stock dividend. 50% is a large stock dividend. So what? 50% on what? 50% on the outstanding shares. How many shares are outstanding? 1,000 shares. So because of this is stock split. Because of stock dividend, the company is going to issue additional 500 shares. How 500? 50% of 1,000 shares. Now, what is the requirement is, under dash or under which of the proposal the par value per outstanding share will dash. So first option, under stock dividend, the par value per outstanding share will increase. So listen, we know that stock dividend will have no impact on the par value, right? Because of issuing 500 shares as stock, because of issuing 500 shares as stock dividend, it is going to have no impact on the par value. So option A cannot be the right answer. Option B says under the stock dividend, the par value per outstanding share will decrease. Again, stock dividend is going to have no impact on the par value. So option B cannot be the right answer. Option C says stock under the stock split proposal, the par value per outstanding share will increase. See, because of stock split, there is going to be an impact on the par value. That is correct. But par value will not increase, but par value will decrease. Right? Just now we saw in this question number 3, because of stock split. Sorry, question number 2, right? Question number 4 now. Because of stock split, the par value of the share is decreasing from 10 rupees to 5 rupees. Right? The number of shares are increasing. So par value is decreased to maintain the same level of equity. Right? So under the stock split, the par value per outstanding share will decrease. So option D is the right answer. Question number 10. Brady Corporation has 6,000 shares of 5% cumulative $100 par value preferred stock outstanding and 2 lakh shares of common stock outstanding. So here the company has preference stock as well as the common stock. The company has preferred stock outstanding as well as the common stock outstanding. The dividend paid on this preferred stock is cumulative. What does it mean? It means that if the company is not paying preference dividend in this period, then the dividend the company failed to pay in this period should be paid in the next period. That is a cumulative preference share. So the number of outstanding preference shares is 6,000 and number of outstanding common shares is 2 lakhs. Brady's board of directors last declared dividend for the year ended 31st May 2010. And there were no dividends in arrears at that time. So the board of directors of this company, they declared dividend on 31st May 2010. That was the last date on which they declared dividend. After that, they did not declare any dividend. And on this particular date, there were no dividends in arrears, which means as of 31st March 2010, the company did not have any outstanding dividends. For the year ended 31st May 2012, Brady had a net income of 17,50,000. The board of directors is declaring a dividend for common shareholders equivalent to 20% of net income. So this is the dividend that is going to be paid to the equity shareholders of the company. 20% of net income. So 17,50,000 into 20%. The total amount of dividend that is to be paid by Brady at 31st May 2012 is how much? That is what they are asking us to calculate. So on 31st May 2012, the company has to pay dividend to common stock as well as to the preferred stock. First, let's calculate the dividend on common stock. Common stock dividend is 20% of net income. That is 17,50,000. So 20% of 17,50,000, we get 3,50,000. So we have 3,50,000 in the option, but we have to calculate the total amount of dividends, not only the common stock dividend. So 3,50,000 is the dividend on common stock. When we talk about preferred stock dividend, the total number of outstanding preferred stock is 6,000 shares and par value of one preferred stock is $100. So the total preference share capital of the company is 6 lakh on which they have to pay 5% dividend. So 5% of 6 lakh, we get 30,000. But this 30,000 is the dividend that is paid from May 31, 2011 to May 31, 2012. But the company did not declare any dividend after 31st May 2010, which means the company did not pay any dividend from May 31, 2010 to May 31, 2011. So during this period, no dividend is paid. For this period, the company is paying a dividend of 30,000, right? But here the question clearly says it is a cumulative preference share, which means here from 31st May 2010 to 31st May 2011, the company did not pay any preference, any dividend on preferred stock, right? So during this period, the company should have paid 30,000 dividend to preference shareholders, but the company did not pay it. So even that dividend should be accumulated and it should be paid in the next year. So 30,000 plus 30,000. So totally it is 60,000. So dividend on common stock is 3,50,000 plus dividend on preferred stock is 60,000. So 3,50,000 plus 60 we get 4,10,000. So option C is the right answer. 11th question. Griffey Corporation declared a 7% stock dividend. It is a small stock dividend. 7% stock dividend on its 10,000 issued and outstanding shares of $3 par value common stock, which had a fair value of $6 per share before the stock dividend was declared. This stock dividend was distributed 90 days after the declaration date. By what amount did Griffey's current liability increase as a result of the stock dividend declaration? See, on the date of declaration of stock dividend, what is the journal entry we are going to pass? Debit retained earnings, and we are going to credit equity share capital. So there is going to be no impact on current liability because of stock dividend declaration. So option C is the right answer. Question number 12. On 1st December, Noble Incorporation's board of directors declared a property dividend payable in stock held in Milton Company. The dividend was payable on January 5. So here what is important to understand is basically the company is paying a property dividend. Declaration date is 1st December. Payment date is 5th January. The investment in Milton stock had an original cost of 1 lakh when acquired 2 years ago. So when Noble Incorporation purchased the shares of Milton Company, it was purchased for $1 lakh 2 years back. The market value of this investment on 1st December was 1,50,000 and on 31st December it was 1,75,000 and on 5th January it was 1,60,000. The amount to be shown on Noble's statement of financial position at 31st December as property dividends payable would be how much? So here we already discussed one question on property dividend, that is second question. So in case of property dividend, what we have to do is the value of the property should be revalued to its fair value on the date of declaration, right? Here, what is the property? The property is the shares of Milton Company, which is going to be paid as dividend to Noble Incorporation's shareholders. What is the date of declaration? 1st December. On 1st December, what is the market value of Milton Company shares? It is 1,50,000. So option A is the right answer. So in case of property dividend, the value of the property should be valued at its fair value on the date of declaration. Here, date of declaration is 1st December. On 1st December, fair value is 1,50,000. So that is the value at which we should show the, and that is the value at which Noble Incorporation should show the value of the property on 31st December. 13th question. The equity section of Smith Corporation's statement of financial position is presented below. They have preferred stock of 12 lakh, equity or common stock of 10 million, and paid in capital excess of par. This is nothing but additional paid in capital. That is 18 million. Retained earnings is 9 million. Net worth is nothing but the total equity, 49 million. The common shareholders of Smith Corporation have preemptive rights. Preemptive rights. What is preemptive rights? It means that, okay, we will discuss that while solving the question. What is preemptive rights? We will discuss. If Smith Corporation issues 4 lakh additional shares of common stock at $6 per share A current holder of 20,000 shares of Smith Corporation's common stock must be given the option to buy how many additional shares. So what they are saying is, first, let's understand what is preemptive rights. For example, let's say I'm holding 1,000 shares in a particular company. I'm an investor. I'm holding 1,000 shares in the company. Whereas the company has the total outstanding shares of 10,000 shares. So as a shareholder, I'm holding 10% of this company's outstanding shares. Right. Now, if the company issues additional shares, or if the company issues additional equity shares, in that case, let's say the company is issuing additional 2,000 shares. So the total number of outstanding share became 12,000. Now, what is my percentage of holding in this company? 1,000 by 12,000, it will become 8.33 percentage. Right. So because the company issued additional shares, my holding in this company has decreased from 10 percentage to 8.33 percentage. So in order to maintain the same proportion of the existing shareholders, the company will So in order to maintain the same proportion of ownership by the existing shareholders, the company will give the company will give a right to the existing shareholders to purchase additional shares when the company is issuing new shares. So that right is nothing but preemptive rights. So here, uh, a shareholder who is holding a shareholder who has 20,000 shares currently, first let's identify how many proportion or what is the proportion of his investment in that company. What is the total number of outstanding shares? Common stock is 10 million and face value of one share is 10. So if face value of one share, face value of one share is 5. If face value of one share is 5, then how many shares the company would have issued? Sorry, I'm messing it up. Extremely sorry. Huh. If face value of one share is 5, then how many shares the company would have issued for $10 million? So 10 million by 5, we get 2 million. So 2 million is the total number of outstanding shares, right? Now, this investor is holding 20,000 shares. So, what is his percentage of investment? 2,000 divided by 2 million. So, 2,000 by 2 million, we get 1%. Now, in order to maintain the same 1% investment, even after the issue of this 4 lakh additional shares, how many additional shares he should purchase so that he can maintain the same 1% ownership? So if the company is issuing additional 4 lakh shares, on this 4 lakh shares also, he should purchase this 1%. So 1% of 4 lakh shares, we get 4,000. So additional 4,000 shares should be purchased by the shareholder in order to maintain the same percentage of ownership. Question number 14. On 1st December, Charles Company's board of directors declared a cash dividend of $1 per share on the 50,000 shares of common stock outstanding. The company also has 5,000 shares of treasury stock. The shareholders of record on 15th December are eligible for the dividend. So what they are saying is 15th December is the record date. What is the record date? The stock is the dividend is declared on 1st December. So any shareholder who is purchasing the share before December 15th will get the dividend. So on 15th of December, if you are a shareholder of the company, you will get a dividend. But if you are purchasing the share on 16th December, you are purchasing the share after the record date, so you will not get the dividend. So the payment of dividend is on 1st January. On 1st December, the company should. So here it is a on 1st December is the date of declaration. So on the date of declaration of a cash dividend, what is the journal entry the company should pass? They have to debit retained earnings and then they have to credit dividend payable for how many rupees? For 50,000. How 50,000? Because the company has 50,000 outstanding shares. So 50,000 shares. For every one share, the company is going to pay $1 dividend. Sorry, $1 dividend. So 50,000 into 1, we get 50,000. So 50,000 debit retained earnings 50,000, credit dividend payable 50,000. So option A says debit retained earnings for 50,000. That is correct, but I'm paid in capital for 5,000. This doesn't make sense. So this is not the right answer. Make no accounting entry. Only for stock split, we should not make any accounting entry. So option B is not the right answer. Debit retained earnings for 55,000. How 55,000? They are taking this 5,000 shares of treasury stock also into consideration. But for treasury stock, the company should not pay any dividend because treasury stock is with the company itself. So option C is not the right answer. Option D says debit retained earnings for 50,000. So option D is the right answer.